take the floor and begin your presentation.
Much, Vera. And can I just check that you can see my screen there now? Okay, so assuming that you can, yeah, thanks Vera, and thanks everyone for joining us for this webinar. Today I'll give you a brief introduction to Exawatt for those of you that don't know us, and then I'll cover three key topics that we think will be of interest in 2023. So I'm going to be talking about cost, and in particular a focus on how polysilicon prices are likely to evolve, because that's been a big topic over the last few years. We'll be talking about technology, looking at the adoption in particular of TOPCon and heterojunction technologies, and exploring how the manufacturing costs of those technologies have been evolving. And finally, talking about global manufacturing, and in particular with a focus on manufacturing capacity expansions in the USA, driven by manufacturing incentives there, and talking about how manufacturing costs there might compare to, say, Chinese or Southeast Asian manufacturing costs. So just to give a little introduction to Exawatt, we are a UK-based consultancy focused on decarbonisation through electrification. Our work spans photovoltaics, power electronics, energy storage, and electric vehicles. And for each of these markets, we study the market by looking at a combination of the supply chain, so manufacturers, capacity, production, and so forth, cost analysis and forecasting, and in particular, we specialize in bottom-up cost analysis, technology forecasting, so a focus on when and how new technologies are likely to influence the market, and finally demand, so looking at downstream demand and how that's likely to evolve over the coming years. And of course, we look at how each of these things interacts with each other. We publish a series of quarterly reports on each of these topics, and we also undertake sort of bespoke consulting projects for clients. So if you think that any of our data or our analysis might be useful to you or your company, then do please get in touch with us. So to start with, just to set the scene for anyone who isn't so familiar with the cost structure of manufacturing a module, here you can see the typical cost structure for a vertically integrated manufacturer in China or Southeast Asia, for example, in the final quarter, so Q4 of the stated year. And you can see that the cost stack is really dominated by materials. They account for about 80% of the total manufacturing cost, and silicon, glass, and frame are all key input costs there. So for Chinese and Southeast Asian manufacturers, many of the process costs, such as electricity, labor, and depreciation, actually make up a relatively small proportion of the total cost. Although, as we'll see later when we discuss US manufacturing, these costs can still be quite important when it comes to considering the differences between different potential manufacturing locations. And you can clearly see from this graph the very high proportion of costs that was attributable to polysilicon at the end of 2022, driven by very high polysilicon prices. And that brings me on to my first topic for today, which is polysilicon. And on this slide, you can see how polysilicon prices have evolved over the last 6 years or so. Obviously, the high prices that we've been seeing has meant that this has been a key topic over the last 18 months. And the key issue over that period has been an imbalance in supply and demand, which has allowed polysilicon manufacturers to achieve very large profits. So for example, Daco's gross margin in Q3 2022 was around 80%, which compared to typically historical margins might have been more in the 25 to 40% region. Now in December and early January, we saw a lot of volatility in polysilicon prices, very aggressive price decline and then rebound. That price behavior was partly due to short-term supply and demand effects, changes in inventory levels and so forth around the end of the calendar year and around Chinese New Year as well. Prices have now stabilized a little bit over the last few weeks, and in the near term, we expect prices to stay much more stable. As well as some of those short-term supply and demand effects, we're also now seeing the fundamental supply shortage that there has been over the last 18 months start to ease a little bit as new polysilicon production capacity has come online and started to produce at high volumes. And here we can see Chinese monthly polysilicon production volumes. And you can see that there was a very large increase in monthly production volumes in the second half of 2022, with production growing around 65% from August 2022 through to January 2023. And production is now around double what it was a year ago. So there's been a lot of increase in production volume over the last 6 months or so. However, we do expect the increase in production volumes to slow a little bit now until the next major round of capacity additions are brought online. There should be some increases, but not quite as aggressive as we've seen through the latter part of last year. There are several major polysilicon manufacturing facilities due to come online in the second and third quarter this year. So we think that realistically, significant further price relief is most likely in the second half of 2023. And by the end of the year, we expect polysilicon prices to be in the range of $10 to $20 per kilo, and around $15 per kilo is our most likely case for polysilicon prices towards the end of this year. Looking further ahead, we can see manufacturers are still planning huge increases in capacity, with total poly capacity set to increase fourfold from the end of 2021 to the end of 2024. And given this huge growth in manufacturing capacity, we expect the market to return to a state of oversupply, bringing down prices, as we said, in 2023. And then also again in 2024, we expect prices to fall to around $10 per kilo by late 2024. That's a figure that's based on our expectations for the manufacturing costs for the cost leaders at that time, and a forecast that those leading manufacturers will see their margins return to a more historically typical level. It's possible that if all of this capacity comes online and all of it ramps to high quality production and full utilization rapidly, that we will see even more oversupply than we expect, and that could compress margins even further. So we could see prices fall below $10 a kilo if that does happen. Now, while poly prices are likely to decline significantly during 2023, there will be some other cost increases for ingot and wafer manufacturers. In particular, we think there are some shortages in the high purity quartz that is used for crucible manufacturing for monocrystalline ingot growth. Prices there have been increasing recently, and we expect that trend to continue, so that will offset some of the cost reductions that we'll see from polysilicon this year. There are a couple of additional complications as well with polysilicon prices. So the first is that the price premium for polysilicon suitable for N-type ingot manufacturing could grow. Whether this happens or not will depend on how successful the polysilicon manufacturers are at ramping new production capacity to meet these specifications. At the moment, we don't expect an extreme shortage of this high quality polysilicon, but we do think that there may be a little bit of a growth in the price gap for that polysilicon, and that's built into our forecasts. The other complication here is really a consideration if you are a module buyer in the USA, and that relates to polysilicon sourced from the Xinjiang region, which can't be used for modules that will be sold in the USA due to the US government's UFLPA regulations. As you can see from the graph, capacity expansions outside of Xinjiang for polysilicon are set to outpace expansions within Xinjiang. The region accounted for around 50% of Chinese polysilicon capacity at the end of 2020. That will be down to around 25% by the end of 2024. So obviously there should be a lot of non-Xinjiang polysilicon available for modules going to the US. Much of that polysilicon should have an industry-leading cost structure as well. And for US buyers, the real key here is whether products made using Chinese polysilicon but from outside of the Xinjiang region can get through US customs reliably. And that all depends on how US customs decides to enforce those regulations. So assuming that Chinese polysilicon from a region like Inner Mongolia can get qualified to enter the US and can safely be used for those modules without a risk of detention, there's obviously a large volume of very low cost polysilicon available for those modules. If we end up in a situation where only polysilicon from outside of China is qualified for entry to the US, and where we see a lot of detentions of modules that use Chinese polysilicon, then we could see a much larger price gap build up with that non-China polysilicon for US supply commanding quite a large price premium potentially. So there's a lot of uncertainty in how customs will choose to enforce these regulations going forward, and how strict they will be and what they will detain. And that customs enforcement is really what will determine how this topic evolves over 2023. But it's very likely to change during the course of the year. So if you are buying modules in the US or selling to the US, this is obviously something to keep a keen eye on this year. So moving on to the next topic and thinking about technology trends, we'll take a look at what we expect from mainstream technologies during 2023. And of course, the big shift here is likely to be from PERC cell technology towards TOPCon and heterojunction. So a lot of what we do at Exawatt is looking at when new technologies will influence the market. And the way that we tend to do this is by modeling what we call the should cost for a given technology. So this assumes that each technology is manufactured at a large scale by a leading manufacturer. It sets aside things like a cost premium for being a small manufacturer or manufacturing outside of China, for example. And we think this is the best way to compare different technologies using this should cost approach. We tend to think about this from a module level, cost per watt perspective. So not just thinking about, say, the cell processing costs for these different cell technologies, but thinking about the overall, what does this mean for an integrated manufacturer producing ingots, wafers, cells, and modules in-house, so that you can account for the cost per watt savings on input materials like silicon, glass, and frames that you get from a higher efficiency technology. And taking this approach, we've been forecasting that integrated TOPCon manufacturing costs will decline below those of PERC, and that this will drive a major transition in the market. And you can see from this graph that we think by the end of 2022, TOPCon was actually now beginning to reach this point for some leading manufacturers where it was a similar manufacturing cost per watt for an integrated manufacturer, one of the leading manufacturers, to produce a TOPCon module and to produce a PERC module. And that cost advantage for TOPCon is set to grow over the coming years. And that's particularly as TOPCon cell efficiencies will continue to improve, while PERC cell efficiencies are likely to stagnate. And by the end of 2024, we believe that integrated manufacturers might be producing TOPCon modules at a manufacturing cost of around 0.6 cents per watt lower than for PERC. So given that, and with TOPCon offering system level advantages, so higher efficiency, improved temperature coefficients, and so forth, we're now seeing the start of a major market shift. And this shift is similar to the transition that the market saw with the move from multi-BSF to mono-PERC. Again, that was a situation where the integrated manufacturing cost for mono-PERC fell below that of multi-BSF. So you had manufacturers able to make a premium product, a higher efficiency product that was worth more to module buyers at a similar or even lower manufacturing cost than the current standard technology. And of course, when you have something like that happens, that drives a market-wide transition. You can see an indication of what's coming here when you look at capacity plans for TOPCon heterojunction and other advanced cell technologies, which we've shown here. In the other category here, we have back contact cells, which my colleague Molly will talk a little bit about later as well. And here you can see that TOPCon capacity plans are really driving ahead of heterojunction at the moment. And partly this is because, as we showed on the last slide, heterojunction manufacturing costs at the moment remain meaningfully higher than for TOPCon. And right now we expect that situation to persist. So we believe heterojunction will need to make cost savings beyond those that we've included in our forecasts if the manufacturing cost is to rival TOPCon. And realistically, we think it's likely that heterojunction will need to establish a meaningful lead in efficiency over TOPCon in order to achieve cost parity and in order to rival TOPCon for being the sort of next core technology that's driving the market. Now, that there are some possibilities for heterojunction to achieve cost reductions beyond what we've modeled. So for example, silver usage, of course, is one of the key areas that adds costs for heterojunction. And in our forecasts that we've presented today, so looking at these cost forecasts here, which show heterojunction staying more expensive than TOPCon, we assume that heterojunction transitions to a silver-coated copper paste for the metallization, but we haven't assumed a transition to copper plating in these forecasts. So if we see a transition towards copper plating, that could potentially help heterojunction costs come down closer to TOPCon costs. And we expect to see a lot of interest in 2023 in copper plating technologies as heterojunction manufacturers look to close that cost gap with TOPCon. So here, this is looking at our forecast for cell technology market shares out to 2027. And you can see we expect TOPCon to rapidly become the dominant technology in the market. This is a global forecast. So for the US market, we may see transition lagging a little bit behind initially. And that's because TOPCon and HJT capacity plans are currently dominated by Chinese manufacturing facilities. So the markets that can be served by those manufacturing facilities are likely to see that transition initially, and somewhere like the US may lag behind a little at first. Okay, so our third topic for today is manufacturing capacity outside of China, and in particular, we're going to talk about the US today. Of course, the key driver for establishing US manufacturing capacity is the manufacturing incentives that have been included in the US government's Inflation Reduction Act. You can see here, this is from our bottom-up cost modeling. And again, this models a should cost. So we can see that we expect Southeast Asian manufacturing to be around 5 to 10% more expensive than manufacturing in China. And that Southeast Asian manufacturing is really what's serving the US market today. US manufacturing adds a lot more cost, so something like 40 to 80% increase in cost versus Chinese manufacturing. However, when you include the manufacturing incentives that are included in that Inflation Reduction Act, they look to be sufficient to make US manufacturing cost competitive with Southeast Asia and even with China. And that we believe is true for each step in the value chain. So for ingot and wafer manufacturing, and for cell manufacturing, and for module manufacturing, we believe that the incentives at each of those steps is sufficient to offset the higher costs of manufacturing in the US. Of course, cost isn't the only consideration for manufacturers. So they also need to consider payback time, the timescale to build the facility, and how long these incentives will be around for. So they will be at their full level until 2030, and then they will step down. And as they step down, we are likely to see a return to the situation where US manufacturing is significantly more expensive than Southeast Asian manufacturing, unless something has changed with the supply chains in that period. And manufacturers, of course, have to consider whether they have existing manufacturing facilities in Southeast Asia, for example. So a manufacturer with existing Southeast Asian cell and wafer capacity might consider a US module facility a good way to access some of these incentives, but whilst minimizing capex, minimizing risk, and also avoiding underutilization of some of their existing facilities in Southeast Asia that they've already set up. But overall, the headline here is that we think the incentives should make US manufacturing cost competitive. And that's true even whether we're looking at our low delta case or our high delta case. And just to explain a little bit more about those, they account for uncertainties around things like capex, labor costs, what labor inflation will do over the next few years, because this graph here is shown for 2025, and things like shipping costs as well, which obviously have varied a lot over the last few years. Now, just to show a kind of example of some of the analysis that we do and why there's a fairly large spread sometimes between some of these low delta and high delta estimates. Here we're showing the capex for some module facilities in China and also two in India on the far right that came online in 2022 or due to come online in 2023. And this is showing the capital expenditure for where we have a breakdown for equipment and then for facilities. And in red, you can see totals where we don't have a split between equipment and facilities from the data that we've got. You can see even within China, where PV manufacturing is obviously very, very well established, there's a meaningful spread in capex between different facilities, especially when it comes to facilities. And there's the buildings, utilities, and all that capex that isn't manufacturing equipment. And we expect that spread in CapEx to be even larger in countries where PV manufacturing is less well established, so places like the US. And that's why there's quite a wide range in some cases between our low and high estimates for US manufacturing costs. So on this slide, you can see an example of where the cost increases are for US manufacturing versus China or Southeast Asia. And this is a forecast for ingot and wafer manufacturing in the US in 2025, assuming that we have a facility that has come online and ramped to full utilization. And you can see here that labor and depreciation are really the key cost adders, which is interesting because, as I showed at the start of the presentation, from the point of view of a Chinese manufacturer or a Southeast Asian manufacturer, these are certainly not the largest costs in the module cost stack, but they do make a big difference when it comes to manufacturing in some different locations. So for example, in the US, labor costs are many times higher than in China and Southeast Asia in many cases, and you may need more shifts of workers as well, which increases labor costs. So as you can see, labor and depreciation are key here. It's not shown here, but in some reports that we've done, we've also modeled what we call an accelerated depreciation schedule. And that's based on an assumption that manufacturers would want to fully depreciate any manufacturing facility that they're building over the period of these incentives that are included in the Inflation Reduction Act. So in that scenario, we assume that buildings and facilities are depreciated over 7 years instead of the typical 20 years. And we depreciate the equipment over 3.5 years to allow for one upgrade or replacement during the life of the facility. So we assume that the facility essentially comes online in 2025 and is shut down again in 2032 when the incentives disappear. In that scenario, depreciation becomes the largest cost adder for this manufacturing, for ingot and wafer manufacturing. It becomes a little bit less clear whether incentives would still be sufficient to offset the extra costs of manufacturing in the US if we assume that's the situation. For cell manufacturing, if we model with the accelerated depreciation scenario, it's actually quite likely that the incentives might not offset the extra costs. But for module manufacturing, even if we assume that accelerated depreciation, our modeling would imply that the incentives should still make US manufacturing competitive. So we're fairly bullish on US module manufacturing and a little bit more cautious on ingot and wafer and cell. If you assume accelerated depreciation, it's a little bit less clear whether the incentives are sufficient. And they are, of course, high CapEx and a little bit higher risk and take longer to bring online as well for potential US manufacturers. Recently as well, while we're thinking about ingot and wafer manufacturing, there have been some news stories about the possibility that there may be some export restrictions on technologies related to large size ingot and wafer manufacturing and exporting those from China. If restrictions like that are brought in, I think a lot of the impact will depend on the detail of those restrictions. For example, exactly what is and isn't restricted and the timescale for those restrictions coming in. At the moment, we expect that those restrictions would cause delays and would add some cost for potential wafer manufacturers outside of China. We don't think it would necessarily stop wafering being established outside of China, but we think it would make it a little bit harder for those manufacturers and add some extra costs, certainly. So here we are looking at US capacity announcements that have happened since the Inflation Reduction Act. So this doesn't include existing manufacturing capacity in the US. It's just new announcements since that act. At the bottom of each stack, you can see the announced capacity, and then the dashed sections show capacity that has either been announced as under consideration but hasn't been confirmed yet, or rumors that haven't been confirmed yet. And at the top, there is some thin film capacity from First Solar and Toledo Solar as well that has been confirmed. So focusing on the confirmed plans, there's around 30 gigawatts of silicon-based module capacity that has been announced due to come online in the US. For cell, it's around 13 gigawatts, but all of that is part of an integrated manufacturing plan. So at the moment, it doesn't look like there will be any possibility to buy US-made cells. There's around 20 gigawatts of wafer capacity, although obviously it remains to be seen whether this will all come online. And there it is not all part of an integrated manufacturing strategy. So there may be some opportunity for US cell manufacturers to buy US-made wafers if they are looking to as well. And then obviously we've been talking about the US here, but there's a lot of interest in regionalizing PV manufacturing elsewhere as well. So India in particular is pushing hard through similar to the US, through a combination of tariffs and incentives. Other regions like Europe are also very interested in bringing manufacturing capacity back to their region, but are maybe a little bit less far down the road in terms of policies to support that. There is significant expansion plans outside of China. So if we look here at wafer capacity, wafer capacity outside of China could grow by 500% from the end of 2021 to the end of 2024. But it's important to understand that this is coming from a very, very low base compared to Chinese capacity. So whilst you could see significant expansion outside of China, realistically, Chinese manufacturing capacity as a percentage of total global capacity isn't likely to change enormously over the next few years. So for example, for wafers, Chinese capacity may fall from around 97% of global capacity to around 95% of global capacity. Now, obviously, production is more important than capacity for market share. But even looking at that, if you were to assume very high utilization for the non-Chinese capacity, so for example, manufacturers in India and in Europe looking to use localized capacity where possible, even then you would only see quite small changes in market share. So the real takeaway as far as global non-Chinese capacity goes is that there's a lot of interest in building these supply chains. There's a lot of interest in building this capacity. We're likely to see significant expansions in the US, in India, and probably to a lesser extent in Europe. But at the moment, we don't see that this will change really the overall makeup of the global market in a fundamental way. So China remains set to stay the dominant force in PV manufacturing unless there is a major geopolitical change over the next few years. So there is room for some growth of non-Chinese manufacturing capacity, but China will really remain the dominant force. So with that, I'll just say thank you very much for listening. If you've got any questions, feel free to get in contact by email, and I'll hand back to Vera, who'll hand over to my colleague Molly, who'll talk to you about some of the trends that we're likely to see in new modules and in global installations over the next year as well.